All right, let's get right into it. Today, we're doing a deep dive into a really powerful data-backed blueprint for investing in coastal real estate, specifically for the market we're in right now in 2026. We're going to skip the basics and give you the actual playbook that serious investors are using to capitalize on the beachfront market. So, what you're looking at here, this isn't just a collection of tips. Think of this as your exclusive blueprint for this year. We've built this entire thing from the ground up to help you really master the market forces, the financing tools, and yeah, even the tax loopholes that are defining who builds wealth on the coast today. This is the all-in-one strategy, and it's all built on the very latest data. Okay, so here's our roadmap. We're going to break down the 5 pillars of this blueprint. First, we'll look at the big picture, what's happening in the market. Then we'll get into the weeds on the financing engine you need to be using. After that, we'll pinpoint the exact hotspots to target for the best returns. Then we'll cover the tax strategies to really maximize those returns. And finally, we'll talk about the secret weapon for long-term growth, something we call climate alpha. So why is this strategy so potent right now in March 2026? Well, it's because the U.S. real estate market has literally split in two. You've got to understand this. It's truly a tale of 2 completely different markets, and getting this split is absolutely key to the whole strategy. This really shows you everything you need to know. On one hand, the national housing market is totally flat. I mean, 0% growth. It's just stagnant. But then you look at the luxury coastal sector, specifically in the Southeast, it's not just growing, it's exploding. This massive gap, this divergence, is the core opportunity our entire blueprint is built on. So what's driving this insane coastal boom? It's being called the wealth migration of 2026. You're seeing a huge shift of capital. Investors are pulling their money out of those traditional West Coast tech hubs, places like Seattle and San Francisco that are actually seeing double-digit price declines, and they are pouring it into what are being called resilience hubs all across the Southeast. And listen, this isn't just a theory. The data is screaming it. Just look at West Palm Beach as one example. While the rest of the country is completely flat, pending sales for luxury homes there are up 30% year over year. That one number tells you everything about the intensity of this wealth migration. It proves that demand in these specific coastal markets is just on fire. Okay, so you see the opportunity, right? It's huge. But how do you actually finance it? Especially if you already own a couple of properties? Well, this is where the engine of our strategy comes in. In 2026, you can basically forget about conventional loans. The number one tool for beach investors is the DSCR loan. A DSCR loan, which stands for Debt Service Coverage Ratio, is a total game changer. Here's why. The lender qualifies the deal based on the property's ability to generate income, not your personal finances. They literally only care about one thing. Does the projected rental income cover the mortgage payment? Your personal salary, your W-2, it's all completely irrelevant. Let me make this crystal clear. A conventional mortgage lives and dies by your personal debt-to-income ratio, your DTI. If you already have a few mortgages, it becomes almost impossible to get another one. Your DTI gets too high. But DSCR loans, they bypass your DTI completely. They only look at the property's performance. And that, right there, is how savvy investors are able to scale their portfolios so quickly. Now let's get into the secret calculation. I'm going to walk you through this step by step. Let's pretend we're looking at a beach house in Gulf Shores, Alabama. Step 1, you calculate the gross monthly rent. So you look at data from places like AirDNA, you check local comps, and you figure out it can reliably bring in, say, $6,000 a month. That's your first number. Step 2, you calculate the total monthly payment, which is known as PITI. That's principal, interest, taxes, and insurance. Let's say for this property, the principal and interest are $3,500, the monthly property taxes are $500, and the insurance is $1,000 a month. You add all that up, and your total PITI is $5,000. Okay? Now for the final step. Step 3, you divide the rent by the PITI. So you take that $6,000 in rent, and you divide it by the $5,000 payment. And that gives you your DSCR ratio. In that calculation, 6,000 divided by 5,000 gives you a DSCR of 1.2. And that right there, 1.2, is kind of the magic number. Lenders love to see that the property's income is 1.2 times the total mortgage payment. It tells them there's a healthy 20% cushion for vacancies or repairs. A 1.2 ratio is your golden ticket to getting approved. Okay, but you have to hear this. This is the crucial 2026 update. This is the real hack. The lending market is so competitive right now, they are fighting for your business, and that means they're loosening the rules. Lenders like Griffin Funding and DeFi Mortgage are now accepting DSCR ratios all the way down to 0.75. Now think about what that means. It means even if a property doesn't break even on paper on day one, even if its rent only covers 75% of the mortgage, you can still get the loan. They are betting on the future appreciation and rent growth in these booming markets. This gives you, the investor, incredible leverage to get into high-potential properties you never could have touched just a few years ago. All right, we have the market trend locked down. We've got our financing engine ready to go. So the big question is, where do you actually put the money? Let's break down the top ROI hotspots for 2026 right now. This table is fantastic because it shows you there are different ways to win. Let's look at these as 5 different investment plays. First up, the growth play, Satellite Beach, Florida. This place is ground zero for the Space Coast tech boom. You've got SpaceX, Blue Origin, they're expanding like crazy, flooding the area with high-paying jobs, and that's driven rental demand up 12%. This is where you buy for appreciation. Second, the high-demand play, Gulf Shores, Alabama. This is your classic family-friendly vacation spot with off-the-charts Airbnb appeal. It's got steady 6% growth, incredible occupancy rates near 60%, making it just a reliable cash flow machine. Third, you've got the luxury play, Miami Beach. It's still the king of the average daily rate, or ADR. You can get $300, $400, even over $500 a night for a high-end property. If you've got the capital, the returns here are just astronomical. Fourth, the entry point play, Daytona Beach, Florida. With a median price around $245,000, this is one of the most accessible beach markets out there. And thanks to year-round tourism from things like the Daytona 500 and Bike Week, you get consistent income. It's perfect for a first-time beach investor. And finally, number 5, the pure yield play, Columbus, Georgia. Okay, it's not directly on the ocean, but its riverside and beach access properties are offering an incredible 13.4% gross yield, with prices under $220,000. This is for the investor who is laser-focused on maximizing cash flow from day one. So you've found the right property, in the right market, with the right loan. Now, how do we pour gasoline on the fire and supercharge those returns? The answer is hiding in the tax code, a piece of legislation called the One Big Beautiful Bill Act, or OBBBA, that passed in July 2025 has completely changed the game for real estate investors. This right here, this is the key to maximizing your cash flow. Let's break these down. First, OBBB permanently brought back 100% bonus depreciation. This is huge. It means if you spend, say, $60,000 furnishing your new rental, I'm talking furniture, appliances, flooring, even building a brand new deck, you can deduct that entire $60,000 from your taxable income in year one. Next, the Section 179 deduction limit was boosted to $2.5 million. This lets you immediately write off huge renovations instead of depreciating them slowly over decades. Then you have cost segregation. This is a powerful strategy where you get an engineering study done on your property. They might find that 25% of your property's value is in things with shorter lifespans, like landscaping or fixtures. By reclassifying these, you can massively accelerate your depreciation and potentially wipe out your entire tax bill for the year. The swap till you drop strategy uses a 1031 exchange. This lets you sell another property you own, maybe an inland one, and roll 100% of the profits into a new beachfront property without paying a dime in capital gains tax. And finally, for the long-term holders, some of these rural beach areas are now designated as Qualified Opportunity Zones, or QOZs. If you invest there and hold for at least 5 years, you get a 30% step up in your cost basis, which is a massive tax benefit when you eventually sell. And now for the final piece of our blueprint. This is the part that gives you an unfair advantage. It's about turning what everyone else sees as a risk, climate, into a massive financial advantage. We call this gaining climate alpha. The number 1 golden rule for climate alpha is simple. Buy high. You have to prioritize properties that are at least 10 feet above sea level. In 2026, these properties don't just sell for more, they are significantly cheaper to insure. And that advantage gets priced directly into the home's value, causing it to appreciate faster than everything else around it. And this insurance advantage isn't just a small thing. We're talking about a direct impact on your bottom line. A resilient property can get insurance premiums that are 15 to 20% lower than its less prepared neighbors. That's just pure cash flow going directly into your pocket year after year. You might be wondering, how do the insurance companies even know which homes are resilient? The answer is technology. In 2026, this isn't about a guy showing up with a clipboard. Carriers are using AI-driven satellite imagery to do remote inspections. Their algorithms can actually spot things like reinforced roofs, impact-rated windows, and modern electrical systems, and they automatically reward the homeowners who've made those investments. So the key takeaway here is you have to shift your mindset. Insurance is no longer just another bill you have to pay. It's a strategic tool. By investing in your property's resilience, you're not just protecting it, you're actively lowering your costs and boosting its appreciation. You are literally creating climate alpha, a durable, powerful, competitive advantage. And there you have it. That's the complete blueprint. You now understand the 2026 market split. You know how to leverage DSCR loans. You can target the right ROI hotspots. You have the OBBBA tax playbook, and you know how to gain climate alpha. This is the exact playbook that savvy investors are using right now to build serious wealth on the coast. So now that you have it, what's your next move going to be?